Imagine a world where doing the right thing financially actually leaves you poorer. A world where saving money makes you vulnerable. Earning more can cost you more. And every attempt to build wealth is quietly undermined by rules you didn't know existed. These aren't abstract ideas. And they're not accidental. They're carefully engineered, repeatedly exploited, and quietly weaponized against the very people they claim to serve. Welcome to the hidden machinery of the modern economy, where incentives are twisted, cycles are disguised as crises. And the system rewards those who understand the paradox while punishing the rest. Today we peel back the curtain to reveal how economic contradictions are used to exploit the masses and why the rules of money have never been what they seem. To understand today, we must first look back. Economic paradoxes are not new. They have roots in centuries of policy, philosophy, and financial experimentation. Take the mercantilist era of Europe, 17th and 18th centuries. Wealth was equated with hoarded gold. Colonies were exploited for raw materials. And trade regulations were designed not to empower nations, but to enrich elites. The paradox was simple. The more laborers produced, the less they actually gained. Economic growth existed, but only for the rulers. Fast forward to the Industrial Revolution. Factories multiplied, productivity soared, and unprecedented wealth was created. On paper, capitalism was delivering progress for all. In practice, it generated the first modern paradox, as output rose. Wages stagnated, debt expanded, and workers became dependent on employers to survive. High productivity didn't guarantee prosperity, created a trap, the illusion of growth paired with structural inequality. The intellectual roots of this paradox were formalized by economists like Karl Marx, John Stuart Mill, and later Joseph Schumpeter. They observed that economic systems, no matter how sophisticated, could create outcomes where individual rationality, working hard, saving, investing, conflicted with collective benefit. Today we call this the paradox of incentives. Doing what seems smart individually can produce systemic vulnerability. The 20th century brought the paradox into sharp relief. Governments assumed central roles in managing economies, but each intervention created new contradictions. During the Great Depression, people saved more and consumed less, thinking prudence would protect them. Yet the paradox struck. Saving reduced aggregate demand, deepened unemployment, and worsened the crisis. The very act intended to secure wealth accelerated loss. Keynes would later describe this as the paradox of thrift, one of many examples showing that individual logic can oppose collective survival. Post-World War II, paradoxes multiplied. Inflation, taxation, and debt cycles created situations where earning more income could push someone into higher tax brackets or remove access to benefits. Here emerged the modern paradox. The system depended on perpetual debt, but perpetual debt inherently eroded financial stability. Paradoxes aren't harmless theoretical puzzles. They are lethal when tested under stress. The 1970s brought stagflation, a phenomenon that defied standard economic logic. Prices rose while unemployment surged, leaving policymakers and citizens puzzled. Working harder did not guarantee more security. Borrowing to invest became riskier. Governments struggled to intervene effectively. The paradox was clear. The system's rules contradicted common sense, and the public suffered. Then came the 2008 global financial crisis. Here, the paradoxes converged in catastrophic fashion. Homeowners were encouraged to take on debt, banks were told to securitize mortgages, and rating agencies legitimized these practices. Individual actors followed the rules, buying homes, investing in seemingly safe securities, only to find themselves trapped in a financial web designed to enrich a select few. When Lehman Brothers collapsed and markets froze, trillions of dollars evaporated, yet those who engineered the system, major banks, hedge funds, and central banks survived. The paradox became obvious. Following the rules guaranteed failure for ordinary participants. but bending or exploiting the rules guaranteed safety and profit for insiders. The lessons of history didn't prevent repetition. Economic paradoxes are now embedded in every aspect of global finance. Zero interest rates, encouraging borrowing to stimulate growth while punishing savers. Holding cash becomes destructive. Taking on debt becomes incentivized, benefiting banks and governments while quietly eroding individual wealth. Stock market inflation versus real wealth. Stock markets rise even as real wages stagnate. The paradox. Paper wealth grows, but the majority cannot access it without risk. And speculative bubbles create cycles of illusion and collapse. Global debt dependence. Governments, corporations, and households are all trapped in debt cycles. Repaying debt strengthens creditors disproportionately, while debt forgiveness or restructuring is rare, leaving the masses perpetually servicing invisible obligations. Even the pandemic recovery revealed paradoxes. Stimulus inflates markets and asset prices for the wealthy, while rising consumer costs disproportionately affect the poor. The system doesn't fail randomly. It fails in a predictable, engineered pattern, exploiting the contradictions built into modern economics. Attempts to resolve these paradoxes often create new ones. Consider quantitative easing, designed to stabilize markets but increases wealth inequality by inflating assets predominantly held by the wealthy. The paradox. Rescuing the economy worsens financial exploitation, universal basic income or stimulus checks. Temporary relief, yet long-term structural debt grows, maintaining dependency on the system rather than dismantling it. Financial regulation meant to prevent crises, but regulators are often captured by the same institutions they oversee. The paradox. Safeguards exist, but protection flows to insiders, not the public. Every proposed fix illustrates the core problem. Economic systems contain embedded contradictions. Rules that appear protective often serve as tools of exploitation, and the masses rarely realize the scale or design of the exploitation until it's too late. To survive in such a system, awareness is critical. Paradoxes often manifest as patterns disguised as opportunity, incentives that reward behavior benefiting the elite but punishing ordinary participants. Policy interventions that claim to help citizens but primarily protect systemic stability or financial institutions. Financial instruments that appear safe but hide risk under layers of abstraction, derivatives, structured products, shadow banking. Recognizing these patterns is the first step toward navigating a system designed to exploit the contradictions in human behavior. There are three clear takeaways: economic paradoxes are engineered, not accidental. Every cycle of boom and bust, inflation and deflation, debt expansion and contraction is predictable for those who understand the system. Ignorance ensures vulnerability. Following the rules is not always safe. Systems are designed so that the rational choices for the majority lead to loss, while those who manipulate or bypass the rules benefit disproportionately. Adaptation requires knowledge, not obedience. Understanding paradoxes, learning systemic incentives, and aligning actions with long-term value rather than short-term rules is essential to preserving wealth and autonomy. The economic paradoxes that exploit the masses today will become more complex tomorrow. AI-driven markets, global debt networks, and invisible financial engineering mean that new layers of exploitation are already being prepared. The question isn't whether the system will fail, it's whether you'll be able to recognize it before it happens. If this analysis opened your eyes to the hidden mechanisms shaping your financial reality, subscribe to the Fiscal Archivist. Comment below with the paradox you've personally experienced and share this video with anyone who needs to see the hidden rules of money before they cost them everything. Knowledge is power, and in a world of engineered economic contradictions, it might just be the only protection you have.